Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my special guest and good friend, Dr. Friday of Dr. Friday's Tax and Financial Services over in Brentwood. She is the tax expert for individuals and small business owners. All right, we're going to hit onto some forms, and as we go through the forms, I'm going to share some additional tips with you. Friday, for this one, the W-2 form is the next one. Let's get that up on there.
The W-2 form, I think, is somewhat self-explanatory. Most of the time, the only time we ever run into any problem is if you have multiple jobs. When people fill out a W-4 form, which is what we use to prepare a W-2, there's not enough federal withholdings. If you've gotten divorced, you may want to go back and revisit your W-4 and make the corrections. If you're single and zero, claim single and zero. If you've got two jobs and you're single and zero, you may have to ask for an additional withholding on the second job so that you have enough taxes coming out. If you have too much, you may need to go the other way, go to single and one. We don't need to give the government any extra money.
There we go. All right. Next form is the big one, okay? This is the 1040 form.
Right.
On your 1040, we're going to walk down through this a little bit. Now, it's small on the screen, but bear with us as you go through. Again, the first part is just name, address, your Social Security numbers, of course, filing status.
Filing status. So the only time that I would basically say that you might want to consult your tax person would be is if you're taking care of a parent or you're taking care of a sibling. In most cases, you're still going to be single, but you might actually add them as a dependent, especially if your parents are solely living off of Social Security and maybe you've got a mother-in-law apartment or they live in the house with you. They may be legitimate dependents. So just take it and consider that when you're filing your taxes, because a lot of people nowadays are helping out their parents, and in that case it may be that there's a small tax advantage for you.
Okay, another is the, so on your filing status, next is exemptions. This is another area, understanding for, this is a pretty straightforward, it's going to typically go up maybe $50 a year per person. So for a married couple, you're going to have two exemptions. That's going to be $8,100. That's $8,100 you're not going to have to pay tax on of your income, and we're going to get to that in a moment.
We're still on page 1, Marilyn.
Okay, so yep, we can go back to that first page.
There
All right. So next part is the income box. All right, so this we talked a little bit about earlier. Number 7 is where you're having your wages, salary. This would be for self-employment. And then the next is taxable interest. This is going to be bank interest, or it could be investment from an investment account, say, stocks, or excuse me, bonds.
And those are the ones you have to remember. We also have the Hall tax still in play, so be careful when you're looking at those federal numbers. Make sure your tax person reviews and make sure you're not having to file the Hall tax here in Tennessee as well.
So again, for those that are not aware, you can...
The Hall tax is $1,250 per person, so it's about $2,500 if you're a married couple. Anything above that, you may be qualified or have to pay tax on. It did come down. It used to be 6%. It's now 5% this year, and it's expected to completely be retired by 2022. So
if you have comments, so if you've got interest income that's over $2,500 for a married couple, $1,250 for a single person. Any interest over that, 5% tax. It's a separate tax return, by the way, that has to be filed with the state for that purpose.
Right.
All right, next is tax-exempt interest, qualified dividends. All of these are going to be part of investment-type accounts. Taxable refunds, credits, or offsets of state and local income taxes. So this is where the Hall tax again.
Exactly. Some of the important ones probably on this form would actually be for most people that are maybe not working, having your own business, will be the capital gains, the loss on your capital gains. We have a minimum of $3,000 if you've got an ongoing loss, or the potential of a larger loss. Maybe you've sold a rental property or something where you might be able to take a larger loss, or if you have losses on rental, because that normally those kind of losses Hank can really maximize. He can take and do some huge changes on those. She's on the Schedule A.
There we go. So we're going to, yes, we want to stay on that 1040 form, Marilena. So we've got taxable refunds, alimony received. If you're going through a divorce, before you go through a divorce, if you're, this is one of the areas to understand how alimony works, how it's tax deductible. So we want to stay on 1040, the front page.
Page first.
First one. There we go. All right, so on that one, again, if you've got on alimony, for the person paying the alimony, it's tax deductible. For the person receiving the alimony, that is taxable income to you. Now, that you do not have to pay Social Security tax, so this is a at least one benefit, right?
It's an awesome benefit, yeah. That does actually come off as just ordinary income, so that can be a benefit. It's not considered earned income, though, so you cannot invest into a retirement account, I don't believe, with alimony. Can you?
Right, and that's a good question, and that one I'm going to have to check.
I'm not positive
alimony,
either.
but I don't believe so. You're right, because it's not earned income. The other part of the when you get into alimony, to understand how that works, again, not subject to Social Security, but that also means you're not paying into Social Security if all you're receiving is alimony, and you don't, and you're not having wages of your own. Now you will, if you've been married for over 10 years, you can qualify to be able to receive Social Security based on your spouse's earnings. Now, that doesn't mean you're going to get the same they did. If they're getting, say $2,000 a month, and you wait until full retirement, when they reach full retirement age, and you wait to full retirement age, you'll get half that, all right? And if they were to predecease you, then yes, you would be entitled to whatever that full amount was. But that's one of the things to understand when you get into retirement planning. This can be a really important part, too, in terms of what you're going to have for income in retirement. Business income, this is one of those for a Schedule C is going to come in. Capital gains or losses.
That's an important one.
Schedule D, I'll let you talk a little bit about.
Well, Schedule D, just if you have stocks and buying and selling, and a lot of times Hank and I will run into, especially people that maintain individual stocks, sometimes the broker will not have the original purchase, or what we refer to as basis, for the stock. So it's important that you actually make sure you have that information. If you don't have that information, that may require a bit more digging, but if you can obtain the information, maybe you inherited the stock, there's a lot of times it's split, it divides, so it's not quite as black and white as you might like it. So getting that basis is so important, especially with inherited stock and things, because you're going to get that step up in basis that you would have, and then if you held it for another 10, 15 years before you sold it, the difference would be then your capital gains.
So again, cost basis means this is what you paid for something, okay? So if it's a stock or mutual funds, a portfolio in general, the amount of money on stocks, let's stick with that. If you paid $50 a share for it and now it's gone up to $75 a share, then that's a $25 capital gain when you sell the stock. You don't have to worry about it until and unless you sell the stock. Then that capital gain could be subject to tax depending on your tax bracket.
Right.
This goes again with where we get into tax planning. If we're going to be selling some stocks, we want to see in advance if that pushes me in a 25% bracket by selling more stock than, say, if I sold less, stayed in a 15% bracket, zero tax, I bump into the 25, I've got a 15% tax. So it's again important to understand these rules so you can minimize your taxes. When it comes to stocks, if you inherit stocks, okay, you get what's, as Dr. Fry said, a step-up basis means that whatever the person that bought it, that's their basis. If they sold it, the gain would be taxable. However, if you inherit it from them on the date in which they died, okay, the value of the stock at that time is your basis. That becomes anything only what you get over that would be taxable. Anything up to that amount is not taxable.
And that applies also to land that you might have inherited, a home that you might have inherited. It's really important. And if you're handling an estate, I can't tell you enough how important it is to get something in writing that produces a basis for all assets, especially when people are maintaining them for sometimes a number of years afterwards and maintaining that number, because otherwise you could end up losing money, because if we can't justify the basis, we may have to go back to where the original purchase was, because the IRS is going to say, if you can't prove that it was worth this much at that time, we're going to go back to the original. And some of these people paid $1,000 for 100 acres, and now, when they passed away, it was worth $100,000, and so on.
And this is the same. As far as the IRS is concerned, if you don't give them basis is zero for their purposes. They'll file a return for you if you don't send in something to say this was my cost basis. Now, that doesn't mean we have to send in a ton of back statements and all that. All we have to do is make the claim, as long as we can support it. The only time you're going to have to worry about it as far as an audit or something in terms of proving. So we want to make sure that we're using real numbers, all right, but we don't have to go through a big hassle in terms of sending in a bunch of stuff. We just have to notify notify them this was our basis. If you do not do that, they assume they see a sale and they don't see where you reported it, they're going to count it. And maybe you think, well, I don't have any taxes on it. It's a loss even. But if you don't report on your return, they don't know that. They're thinking it's 100% gain. They'll redo your tax return, calculate penalties, interest, everything else, and yes, you're going to get a letter saying, hey, we redid your tax return.
Exactly.
You now owe us. We had one extreme of that. It was, I think, about $37,000 that I had a client that had sold some stocks and didn't report it, and that's what happened.
Yep.
We went back and we showed them, here's our basis, and we showed, of course, it was zero tax. But that's, again, why it's so important. And this is why I do reviews, too. So when a client does something on their own and doesn't notify me, I'm not able to make sure those things don't happen. Well, a lot of times we can fix them, but it's better not to have to go through all that in the first place.
Yeah.
All right. On that 1040, some other things I want to hit real quick on the front page there to look for. IRA distributions, we talked about that. You'll have both a taxable, it'll give you the total distribution, and then the taxable amount, where Roths come in and other things. That could be Roth conversions. That can be a big part of that. Rollovers. Again, you might have an IRA distribution. It shows I took this money, but I just moved it over here, so the taxable amount would be zero.
Right.
All right. So that's something that on a recharacterization we can have something similar. Pensions and annuities, the taxable amount. Sometimes people have pension income that's not taxable. Annuities, same thing. The principal amount that you put in, the original money you put in, if it's not an IRA, you've already paid tax on it. Right. It's only the interest that's going to be taxed. All right, we're going to take a quick break. When we come back, I want to finish out this front page. This is so important, and then get into a little bit about itemizing if we have time. Wow, the morning goes by fast, doesn't it? All right, but I at least want to make sure I help you with this part, because we're going to get into Social Security, and that's one of the trickiest parts when it comes to your taxes, and it's real important. If you understand the rules, you can save a lot of money in taxes on this end, all right? So join us here. We're going to get into that and more when we return on the Retirement Report.